What's up guys, welcome back to another video. While we have already talked a lot about the future of our economy on this channel, we have never really talked about the industry that is going to fuel that future. So that is what we're going to do for today, as we're going to talk about the energy giant Exxon Mobil. Before we get to the introduction, I however have to say that I'm not a financial advisor, and you should not base your investment on my video. Please always do your own research. Like I've already mentioned, Exxon Mobil is an energy company which is headquartered in the US, or to be specific, Irving, Texas. They focus on the exploration and production as well as other services in regards to the crude oil and natural gas market. But more on all of this later on. Let's start out with the company's market cap when we get to the financials though, which currently sits at right about 146.6 billion. Which is a huge drop from the company's all-time highs. However, this valuation still does not come out of thin air and can somewhat be attributed to the revenue of the last fiscal year, which sat at about 255.5 billion US dollars. However, let's break that revenue down a little bit further, so we can already get a brief overview of what makes Exxon Mobil money to what extent. Generally speaking, Exxon divides their business into three key segments. These are Downstream, which makes up the majority of their revenue with about 204.5 billion US dollars. Just so you directly are aware of what Upstream is, this includes things such as drilling for oil and natural gas, and obviously selling it. This is then followed by services in regards to chemicals, which lag behind with a fairly big margin by only sitting at 28.1 billion. And last but not least, we still have the Upstream segment, which contributes the missing 22.9 billion US dollars. But enough with the introduction, which we have now knocked out of the way. Let's move on to something which you probably all want to know about, which are the distributions to shareholders. At the current point of time, Exxon Mobil returns capital to shareholders through dividend and share buybacks. And that at a pretty generous pace, if you ask me. However, at first, let's focus on a dividend, which currently sits at right about $3.48, equaling a current yield of just above the 10% mark. But while we have now somewhat talked about the current distributions, let's also have a look at the past distribution history, as this can indicate how focused on the dividend a company actually is. For the case of Exxon Mobil, we are able to recreate the dividend until the year of 1911, which has now been constantly growing for right about 37 years at a growth rate of about 6.2%. This in itself already seems to make Exxon Mobil an appealing dividend play on its first sight. When it now however comes to stock buybacks, these are harder to track. However, it can be said that these are somewhat less consistent in their growth. But in order to figure out how much Exxon Mobil actually distributes to their shareholders and how sustainable these distributions are, let's put the total distributions into contrast with the free cash flow. Right from the beginning, we can see that these exceed the free cash flow in every year except for 2017 and 2018, due to the free cash flow peaking in these 2 years. This obviously is not what we want to see at all, as this means that in the long term, the company has to take on debt in order to cover those distributions to shareholders. But let's also have a look at the balance sheet in order to evaluate the overall financial position of Exxon Mobil even further. As per usual, let's start out with the year of 2015, in which Exxon Mobil's total assets sat at about 336.7 billion US dollars. These were made up by about 42.6 billion in equity, 19.9 billion in long-term debt, 18.7 billion in current debt, and 255.4 billion in non-interest paying capital. But in order to be able to actually evaluate this even further later on, we want to calculate the net debt. This is obviously done using Exxon's debt and its cash position. For the year of 2015, this sits at 34.9 billion US dollars. But let's set that value to the side for now and get back to it in just a second, after we have taken a look at the balance sheet of 2019. As you are able to see, Exxon's total assets increased over our time frame to about 362.5 billion US dollars. These were made up by about 50 billion in equity, 26.3 billion in long-term debt, 20.5 billion in current debt, and 265.6 billion in non-interest paying capital. But now let's calculate the net debt like we did for the year of 2015. This time, however, we get a net debt of 33.2 billion, which is already a somewhat decent increase. But let's also find out how sustainable the debt which we have just calculated actually is, and whether the debt has gotten more or less sustainable. This is done using the EBITDA, which is the pre-tax, pre-interest, pre-depreciation, pre-amortization income of said company. After doing our basic calculations, we are left with a sustainability of 0.86 for the year of 2015 and 1.09 for the year of 2019, which both times means that the debt could be paid off in round about 1 year, with however the debt becoming a little bit less sustainable in 2019. Alright, since we now have the financials covered, what we want to do is get the margin of safety, which will help us with determining our buy price later on. This is done by collecting arguments for and against an investment in Exxon. But let's start out already. First of all, while some might consider the oil industry a dirty business, it is a business that pays really well. A dividend yield of almost 10% isn't really the norm for highly valued and popular companies across the market. So especially if you do not care too much about things like the green or ethical investing approach, a company like Exxon, which is a figurehead business of America's past, can boost your portfolio yield by a pretty huge amount, resulting in a ton of extra income at a historically low price point. Therefore, I'm going to reduce my margin of safety by about 5%. My next point is actually also somewhat connected to the one above, and that is that the business of oil and gas has a fairly big moat. While I'm a huge fan of renewables, I would be lying if I told you that the oil industry would disappear in the next 20 years. Moreover, they actually are somewhat required in order to fuel the economy that is switching to renewables, as well as keep the lights of our economy going. A switch to renewables, especially in the travel industry, does not happen all of a sudden. And if it does, you can bet that the big energy companies like Exxon are looking to be a part of the renewable segment as well. Therefore, I'm going to reduce my margin of safety by about 15%. However, sadly, Exxon isn't a perfect business and has some downsides as well. While I've previously already said that the oil and gas industry won't disappear overnight, one is starting to see some cracks in their business, especially due to the low demand and low price for oil during the corona crisis. Will the travel and flight industry, which buys tons of fuel, get back on its feet? Probably. However, that could still take some time, as we don't have a clue how fast the recovery from the COVID pandemic will take place. Therefore, I'm personally uncertain how the outlook for Exxon's coming 2 to 3 years will look like, which leads me to add 5% to my margin of safety. In addition to that, I'm pretty concerned about the distributions of Exxon, which in my opinion are an appealing selling point of the company, and that is not even due to the COVID pandemic price drop. The company has been struggling to cover these distributions with their free cash flow for quite some time now, which leads them to take on a ton of debt. While this in the big picture of the past hasn't yet been something that directly jumps into your eyes, it is a concern I really got for the long term. And especially with the downturn of the COVID pandemic, I can only see the borrowing increase even faster due to less free cash flow this year. Therefore, I'm going to add 10% to my margin of safety. In order to get the fair value of the stock, we have to take a little look at the historic dividend yield. For the past 10 years, we had an average dividend yield of 3.27%. This obviously means that you want to buy the stock if the yield is above that average. This would mean with the current dividend of $3.48, a fair price to pay would be $106.42. Note, this however is only in respect to the dividend. If we now want to calculate the value I would pay for the stock, all we have to do is again get the average dividend yield of 3.27% and my safety margin of 20%. This gives us our target yield of 3.92%, which leaves us with a price to buy the company at of $88.77. However, a more reasonable fair price to buy the company at with its future outlook for me would be right about $65, with a personal buy price of $47. Overall, I would currently rate Exxon an absolute buy for those looking to invest for a more medium time frame.